Hey everybody, Peter Lassar here. This is episode 12, and there's something that I feel needs to be said. We have a lot of sort of fear and worry, and then uh, on the other hand, a lot of excessive optimism in this industry. In other words, there are many times when I speak with restaurateurs who um, are unnecessarily fearful or unnecessarily and unrightly overly optimistic. And of course, this has to do with the swing in revenues and income, right? And I really want to give you a long term perspective of what is going on in your business and in our industry so that you can focus on actually what matters the most of all and can sort of move out of this back and forth swing of optimism and pessimism, which is really an undercurrent that I see time and again with folks in our business. So I'm going to go ahead and share my screen here. And the name of this episode 12 is Math Proves You Worry About the Wrong Thing. And before I get started, again, if you like this video, if you like what I've been doing with this channel, then please go ahead and subscribe, give this video a like, and get notified when more and more of these videos come out over time. And they're coming out almost every single week. And in the months to come, there's going to be a much more differentiated content. There are going to be interviews. There's going to be a lot more benchmarking, though today is sort of a benchmarking video, and you're really going to get to be exposed to a lot more value. So please stay tuned for that. Now, I want to talk about the restaurant suck and awesome scale. This is something I made up, but it comes right out of investing. And so there's something called the Fear and Greed Index that some of you might be familiar with. And the Fear and Greed Index is when the market is full of froth because they're greedy prices, equity prices, or Bitcoin prices, or whatever you follow, are pumping really hard, and people are getting greedy and piling in, and fear is when prices are falling really quickly and people get fearful and drive out, right? And of course, you're supposed to do the opposite. You're supposed to accumulate when pricing is low, and you're supposed to sell when pricing is high. But the point of the Fear and Greed Index in investing is to show people how their emotions are working against them. Okay. And with the suck and awesome scale for restaurants, my intention is to help you to do the same thing. So if you look at this chart here, it reflects restaurant sales for all restaurants and other eating places in the United States, starting in 2000 on this particular image you see, all the way to 2022. Okay, and what you're going to see is a gently sloping sort of line, right? But with a lot of little ups and downs. Okay, and this is the suck image, because you'll see there are a series of red arrows pointing down, and those are periods of time in that long-term trajectory when revenues take a bit of a dip, right? And people start to get fearful, and that's when I tend to get the most calls. Okay, people are fearful and they literally call and they say, "I suck." You know, they think that they can't figure this thing out, and they feel awful about themselves. Okay, or they just feel really worried. Okay, and and yet those blips, or those dips, I should say, except for maybe in the one around COVID, and sort of this like weird inflationary period, which is highly volatile, are relatively small in the long-term scheme of things. Okay, so that's the suck part of the restaurant suck and awesome scale. Here's the awesome part. You also get, during this long trajectory of growth, lots of little bumps up. Okay, and I know this is happening because The people who reach out to me tends to reduce some, okay, and people feel like they are awesome all of a sudden, and they become overly optimistic, not understanding in both the suck or the awesome part of the scale that they are just caught in this long-term trajectory, and that's really what I want to show you now. So, sector-wide revenue growth has compounded at a rate of 5% per year since 1992. So, since about 8 years before the beginning of this particular chart. Okay. So, for the last 30 years, we've had roughly a 5% rate of growth, spread out over those years. So, annually. Okay. And of course, it's been like this. And so some years that means we went up 10% and people thought they were God's gift to restaurateurs. And some years we flattened or dropped a few percent and people thought that they really didn't know what they were doing anymore. Okay. And, um, and that emotional reaction to these dips and these bumps really takes you away from the long term focus of what is happening. And that is, if we are growing at around 5% per year on average over many years, we're actually a very slow growth industry. Okay. And so I want you to take some awesome out of this particular image and some suck. Okay. It's awesome that you can rely on that our industry is growing over time at a fairly steady rate. Okay. So when things are dipping, you know that that's going to reverse at some point. Okay. And I want you in those sort of sucky periods to take feel something good, which is you're just in this little predictable up and down period over a much longer growth trajectory. Okay. The long term suck here is that it's actually quite a slow moving sector, right? There are many sectors that grow at much faster rates than this, but because restaurants are such a mature sector of our economy, they grow very, very slowly. Okay. And so that sort of stinks because it produces a bunch of problems itself. Okay. Now, and we're going to come to those problems in a moment. Now, I want to give you a little more awesome again, okay? Just to play with that term a little bit. If you look at just 2020 to 2022, right? There's actually been about a 300% sector revenue growth over those 22 years, right? And and so that's a lot of growth, but it's over a very long period of time, right? And so you also need to understand over that period of time what else is happening. And so while there has been 300% revenue growth for the entire sector over about 22 years, the number of restaurant units, so individual stores, has grown by about 65%. So we have about 65% more restaurants in America than we did in 2020. Okay. Meaning that the revenue per unit hasn't grown by 300% on average, but has only grown by about 80%. Okay. And so there's a little bit of an injection of reality. And here's where that 5% really hurts us because we've only had 5% sort of annual growth on average, right? But the inflation rate has run over this period cumulatively by approximately 72%, meaning that revenue per unit in real dollar terms has increased by only around 10% over 22 years, meaning about a 0.5% a year. So, in other words, we've had this long-term trajectory that you can feel awesome in or feel sucky in, depending on the the ebbs and tides of the seasons or of the given years, right? That over time has continued to grow at about a 5% clip, and that's good. Okay, that there's some predictability there, but because of the growing number of units, okay, and because of inflation, right? The real dollar growth in revenue has only been about 10% per unit over the 22 years. Now, and that's less than 5% a year, or less than a half a percent a year, excuse me. So, what does that tell you? I'm going to stop sharing this for a moment, and then we'll share it again. Give me 1 second here, okay? What this tells you, well, it tells you multiple things, and I'm going to give you a couple more perspectives with some other math. But um, it might tell you that you've done better than others, okay, because you've been around a while and you've sort of dialed in your business, and it might tell you that you've done worse than others. That you need to figure out, right? And we also need to take into account that there are many restaurants that open and fail within years, as we know, and their bad performance is also caught in this. Okay. But guess what? Chains are also caught up in this, and chain revenue per store growth over long periods of time tends to be much higher than sort of the average independent restaurant store growth sort of over time. Okay. And so, it's a very mixed picture, okay? And that mixed picture is uh, full of your sort of suck and awesome emotion, and you just need to back out and understand that we are in an industry that your only choice is really to try to break out of these trends that everybody else is facing, okay? And there are a couple ways to break out. So I want to go back to our share here for a moment and walk you through that. So one way to break out is time. You just have to let time go on, and that fixes sort of this caught in this trap of moderate growth over a long period of time that on a real dollar basis isn't really much growth at all. Okay, so I want to explain this. This is a table that is similar to a table that's in my book. There have been a couple little changes in here, but I want to walk you through it very carefully to talk about time. Okay, so I'm calling this the base case restaurant. As you can see at the very top, I want you to focus on where it says A to the left. Okay, so this is, by the way, a 20-year P&L forecast. And you'll see when you look at A, the very top arrow points to years. So this is the first year of a business of a restaurant, the 5th year, the 10th year, the 15th year, and 20 years. So it skips in 5-year intervals, okay? The second arrow, the middle arrow for A, says that the revenue growth rate is going up at 5% a year, which is in line with our long-term performance of our industry, okay? And the bottom arrow of A says the restaurateur has managed to have expenses only increase by about 4% per year, right? And that means that they've been able to control their expenses a little bit year on year compared to their revenue growth to get better and better results over time, which is typical of a healthy restaurant. Okay. Now, if you look at C really points to this green column in the middle, and it just says, our food costs are 32%, our beverage costs are 25%, and you go on down and it says, you know, salaries and wages in year one were 25%, employee benefits were 5%, and so forth and so on, all fairly standard numbers. Okay, but after year one, all those expenses grow at about a 4% rate, while revenue grows at a 5% rate. Okay. And if you look at B, it says revenue year one was $1 million. This could be 100,000. It could be 3 million or 10 million. It doesn't really matter. There's a base case here, and it's growing at that 5%. Okay. So if you look at D below, that's the EBITDA line, which is earnings before interest, taxes, depreciation, amortization. It's similar to your net operating income for those who are not familiar with the term. And it shows that under these fairly standard metrics, year one produced about $61,000 of EBITDA, or roughly $61,000 of net operating income pre-tax. Okay. Just letting time go by of that 5% rate on average and a 4% rate of expense growth on average, by the time you reach year 20, your EBITDA is about $400,000. Okay. Now, your EBITDA, so those numbers are a little bit false in the sense they don't represent real dollars, right? These are just dollars over time. But I haven't set this, at a real dollar rate based on 2022, for example. This is just total dollars over time. Okay. But what it does show you is in year one, your EBITDA or your net operating income margin was roughly 6%. Okay. And by the time you got to year 20, it was roughly 20%. Okay. And I see this all the time. I see restaurants that have been in business for many, many years that have 20, 25%, even 30% EBITDAs. Okay. And I see restaurants that start off with negative EBITDAs or marginally positive EBITDAs, but if they were to control their expenses over the long run and just let the time play out, this is the sort of thing that would happen to them. Okay, and so time fixes this issue you have that all of us have of how do we build more income for ourselves, right? And so there's the time of the whole sector where there's all sorts of things good and negative happening in that sector. Restaurant closures versus chain restaurants outperforming independents. But within that is the time schedule of an individual restaurant. And if you could just hold on, this is the sort of thing that typically could happen if you were able to control your expenses and hit those averages. Okay. But I want to show you that growth rate is what really fixes all of your sort of challenges fully. Okay. And so this is the exact same P&L forecast. And there's only two differences. Okay. If you look at A, the first difference is that your revenue growth rate is 2 points higher. It's 7% rather than 5%. So it's you, like most of our leaders, okay, beating the industry average year in and year out for many years. They have a faster revenue growth rate than the rest of us, okay, on average. And they are controlling their expenses. So they don't have 4% expense growth rate, but they have 5%. So as we're having more and more revenue growth, the amount of our expense growth decreases, grows at a slower rate. Okay. But it's still faster than what the standard would be. Okay. When you let that play out, if you look at that blue line at the bottom, okay, look at B, the first top arrow, your EBITDA in year 20 isn't 423,000, it's 900, almost 18,000. Okay. Just the slightly faster growth rate gives you more than double the financial impact in terms of income. Okay. And if you look at that second arrow, it shows you that by year 20, your annual EBITDA variance is almost $500,000 greater than year 20 in the baseline case. And that goes growing over time. So by year 5, it's about $37,000 greater. Year 10 is about $119,000 greater, and so forth, because over time, that's how those spreads play out. Excuse me. But if you look at cumulative EBITDA variance over the 20 years, all those individual years mean that you made almost $3.5 million more pre-tax. Okay. And that this is the difference between an extremely valuable business, obviously one that has sort of changed the lives of those who are involved in the business to a much greater extent than what is the standard case. But also, if you ever wanted to exit, these types of businesses can easily get a 3 or 4 times multiple. So you're talking about, so 917,000 times 3 would be almost $3 million. 4 would be $4 million. But if you're growing at a base case, okay, that 420, you'd be getting roughly 2 times EBITDA, so $850,000. So 850 versus, $2 to $4 million on this particular case makes for a very different level of financial security at the end of your life, if that is your plan, or to pass on to somebody else, or to use for financing in order to scale, and so forth and so on. Okay, so the point here is really threefold. You need to stop feeling awesome or sucky with the short-term shifts in results. You're feeling awesome and not focusing on your revenue growth rate because things are cycling up and you just feel overly optimistic is killing you, probably even more than feeling sucky during the dips when at least you're trying to work on it, not just ride it out. Okay. Next is, as I preach time and again to clients, you need to worry most about building a revenue growth rate that is consistently year after year after year after year above that of the marketplace. Even 2%, 2 points higher makes a huge difference. 3 points higher will make another like $1 million difference in valuation over those 20 years, and so forth and so on. Okay. That is how you get your house permanently fixed and in order. Okay. That is how you fix your house, revenue growth rate. Otherwise, you are in this sucky, awesome rotation, this, up and down scale time and again, because you particularly feel vulnerable when you're growing at the rate of everybody else. And the reason is because growing at a similar rate to everybody else over a long period of time doesn't give you more resources than they do to feel more comfortable or to reinvest to grow at even faster rates. It just sort of keeps you trapped in a very vulnerable spot, which is where most restaurants are over their lifetime. Okay. And so to get your house in order, you need a faster growth rate in order to have more resources, in order to continue to grow at faster rates and to get in that virtuous long-term cycle of outperformance. Okay. And finally, our leaders are market leaders based on their outsized growth. That's how they got there. This sort of achievement over years is how they got there. Okay. And you only need to look to them for lessons, because if you're looking to peers that long term have not outperformed, because if they have, they're now no longer peers, right? You're looking at people that have similar outcomes to you. Okay. And they haven't really figured out the big, important, sort of game changing lessons that our leaders have. And so you need to be observing our leaders and trying to extract those universal lessons that apply to leaders across all segments of our industry. And those are the lessons that really make the biggest difference to that growth rate over time, which is exactly why I spent so much time understanding them and deploying them myself. Does that make sense? So the math proves you worry about the wrong thing. I really want you to focus on the right thing, because otherwise we get caught in a trap of our own making, so to speak, because we have trouble even understanding that we are in a trap in the first place.